Hey guys, how's it going? It's Andy from Go Investing. Happy Wednesday. So for this past week, I've been reading a lot. The book I've been reading is by Jim Cramer, talking about him starting up his fund and trading stocks in like the 80s up until around 2000. And towards the end of the book, he talks about how he's so stressed out after a really tough week trading stocks that he decides to go to Amazon and buy a book. And when I read that, I was like, Amazon, oh, that's right. Sometimes I forget that Amazon started out as a book company, and now it has expanded to this giant e-commerce company. And so I wanted to talk about some of the other e-commerce giants out there, because I feel like a lot of people either think that they missed the bus when it comes to investing in a company like Amazon because it has grown so rapidly over the past 2 decades, or they want to find something that maybe has a little bit more upside. Also, there are some people out there that absolutely hate Amazon for what they do. So in today's video, I'm going to be talking about 6 e-commerce stocks that I would consider buying instead of Amazon. They all have their pluses and minuses. If you've been paying attention to this sector, these are companies that have done incredibly well in 2020. And I'm going to be talking about one stock towards the end that I'm really excited about because it is a e-commerce stock that is not talked about a lot. And it's in an emerging market that could have huge upside potential, but it does have some risk involved in it. Yesterday, I talked about some potential catalysts that I'm watching to see if the stock market is going to crash in 2021. And if you missed that video, I'll link it up above right now. But one of the things I was watching had to do with the FANG stock earnings. That's Facebook, Amazon, Apple, Netflix, Google, and then you can throw Tesla in there. And the first of these stocks was Netflix, to release earnings yesterday, and they ended up beating expectations. So I'm going to have to wait until next week to see what happens with the rest of the FANG stocks. Just a reminder that since I am talking about 6 different stocks today, there are going to be timestamps in the description below if I'm talking about a company that you don't really care about and you want to skip ahead. Also, a reminder that I'm not a licensed financial advisor and this is not financial advice. Anything you hear in this video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, really appreciate it if you hit the like and subscribe button, as would help my channel out a lot. So the first stock I want to talk about today is going to be Alibaba, ticker symbol BABA. And the reason I want to talk about it, it's had a lot of drama behind it for the past couple months. And so I've talked about it probably like 4 times in the past couple months, and the main reason behind it is their CEO and founder, Jack Ma, had not been seen since October. And so when the news came out that he was potentially missing, the stock fell, and then there was a news release saying that he was just lying low, and then yesterday was actually the first time that he's been seen out in public since October, and as a result of that, the stock has jumped around 5% today. So it's always good to see the CEO come out of hiding after just a couple months. So the stock has had some interesting problems in the past couple months. The largest and probably most interesting is the fact that the Chinese government is investigating them for monopoly allegations. And so it is never something I thought I would have to say about a Chinese stock, but this comes after Alibaba's IPO was delayed, after Chinese regulators wanted them to be more transparent with some of their financial stuff, and Jack Ma came out and kind of criticized the way that the Chinese government was running things. And then, he disappears and now he finally pops back up. But looking at the 1-year chart, you can see the result of those recent sell-offs, but they've still had a pretty solid year. Then you look at the 5-year chart and they've had an impressive gain of 275%. Comparing the 2 Chinese giants when it comes to e-commerce, you have Alibaba and JD.com, ticker symbol JD. And so when we talk about companies that could become the next Amazon, I think you have to discuss Alibaba and JD because I think they're the closest that you have right now. However, they do operate in very different ways. And I think the closest you could get to creating a Chinese Amazon is if you mushed the 2 companies together. So Alibaba is mainly the marketplace for things that are listed, and they bring in a fee for that, and that's where almost all of their revenue comes from. They are massive with 742 million active customers annually, and they have the massive size like Amazon, and they've seen incredible revenue growth over the years. Because of the fees being one of the largest sources of revenue, it has extremely high margins of between 20 and 30% depending on the quarter. And with Singles Day, which is a huge shopping holiday in China, kind of similar to what we have with Black Friday, Alibaba and JD together brought in $115 billion in total sales. It's usually like a 1 or 2 day sale, but this year they had it from November 1st until November 11th, 11/11. And so Alibaba saw their sales double from last year up to $74 billion total. And comparing them to Amazon, they're also rolling out a cloud service similar to what Amazon has with AWS. And if you've been paying attention to Amazon's earnings for the past year or so, that's probably the area that people are most excited and most curious to see whenever the earnings reports come out, because this has become a massive and highly profitable part of their business. However, they're not to the point where it's become a widely profitable business like AWS. It has increased its revenue to $5.65 billion in revenue in 2020, and that's up from $2.14 that we saw in 2018. But at this point, they're still running at an operating income of around negative $1 billion. And so while the margins have improved, the company hopes to be profitable by the end of fiscal 2021. So if you're comparing this company to Amazon, and you've seen how profitable the AWS can be for Amazon. This could be a huge source of growth going forward when it eventually becomes profitable, and it should be a massive moneymaker for the company going forward. But now I want to talk about JD.com, ticker symbol JD. And so they're more of the actual merchant, and they sell their own products. So when you look at Amazon, yes, they do sell things and they produce fees for people that want to sell on their site, but they also do a lot of their own selling of merchandise. So that's why I kind of compare them as being Amazon would be what China has if you merged Alibaba and JD together. One of the most exciting parts about JD is that they have a very impressive logistics network. It has resulted in their demand spiking during the pandemic. From what I could find, their logistics network provides next day or faster shipping to 99% of the population in China, which is incredibly impressive when you think about how many people live in the country of China. As a result, the stock was up 150% in 2020, and that's shown from the 1-year chart. And then the 5-year chart shows a similar gain to Alibaba, being up 250%. As I mentioned, JD and Alibaba are both e-commerce giants, but they do run slightly differently. And while JD has a significantly lower market cap, they actually have higher revenue than Alibaba, which kind of surprised me. But if you think about the way that the companies are run, since JD is selling their own merchandise, their revenue is significantly higher. But the difference is that since they are doing all the logistics stuff, their margins are much lower. And so just a reminder that Alibaba's margin was around 20 to 30%, and JD.com is only around 4%. But they have been expanding. They're going to be creating a cloud business and a telehealth business, but they don't create much revenue yet. So when you look at both JD.com and Alibaba, they do have growth potential in the future, considering they're both working on a cloud business, but they have not gotten to the point where they're profitable. And then JD.com, they still haven't created that much revenue with it yet. So they both do have growth potential. They are up significantly, and I do like both of them, and I'll talk about how I'll rank them towards the end of the video. Now we're going to be going back to the American stocks with Etsy, ticker symbol ETSY. I talked about Etsy in a recent video, so I'm not going to go too in depth in it, but currently it's trading for $217, and it's up already 22% in 2021. Looking at the 1-year chart, they've seen a lot of growth, and it's up almost 330% in the past year. And then with the 5-year chart, they're up 2,800%. So the question that I always see with this incredible growth is it sustainable? Because that is a crazy jump in price within just a couple years. And so the rest of the American stocks for this video all make money from listing fees, unlike JD that sells their own products. So as a result, we're going to be expecting higher margins in something like a JD, but lower overall revenue compared to what JD brings in. So when you look at the net margin, they're sitting at around 17%, which is pretty decent. It's slightly lower than Alibaba, but compared to the American markets with how much competition you have with the e-commerce stocks, I'm not that surprised about it. They have seen some crazy revenue increases during the pandemic. And when you look at Etsy as a company, people have been kind of critical about the way that they've been making money, seeing they've been relying heavily off of the boom in demand from the pandemic. And a lot of people have been selling masks on the site. And so the numbers I could find is that 11% of their overall sales were from masks, but they did see a 93% increase in sales when masks were excluded. So the company did see explosive growth in 2020, and it's not only because of the mask, but that was a part of it. Their expected growth for next year is going to be 12%, which is obviously much lower than the 97% increase that you saw in 2020. When I look at companies that did well in the pandemic, the first thing I think of is it a fad or is it here to stay? And their largest category is homeware and home furnishings, and that's just not something that gets me super excited. I have no reason to believe that Etsy is going to go away anytime soon. The 12% expected growth for revenue in the next year is very solid, but it's nowhere near what we saw with the 97% increase in 2020. So based off of that, it's not my favorite e-commerce stock out there, just because I think that the explosive growth that we've seen in the stock price, it's going to have to sell off at some point. I don't know if it's going to be anytime soon, but it's a little too risky for something that I'm looking to invest in right now, as I'm kind of expecting the market to pull back as a whole. So then we go to a direct competitor with Shopify, ticker symbol SHOP, which is trading for $1,200, and it's up 5% on the year. The 1-year chart is impressive, being up 157%, and the 5-year chart shows how the stock took off in the past year, and it's up 5,100% in the past 5 years. So you're going to see a lot of similarities comparing Shopify to Etsy. Looking at their revenue chart, growth was slowing until the pandemic hit. But even though I say that growth was slowing, they were still seeing 17 to 20% quarterly growth year over year. So while it had been shrinking when you see the recent increases in price, they were still growing at a pretty high margin. However, their margin looks a little bit different. With their last quarter, it was their first time that they've had positive net income. That gives a net margin of only 8%. So it is much lower than what we saw with Etsy. But from the numbers that I could see, it has to do with the fact that they've been spending a lot to improve their logistics network, and they've been investing in themselves heavily, and that's why they have not been profitable up until this past quarter. Some of the most impressive numbers that I saw is that they've been seeing growth with revenue at a compound annual growth rate of 71% over the past 5 years. So this is explosive growth, and they've been doing it over multiple years and not just the fad of the pandemic. And that's why I like it slightly more than something like an Etsy. And so for people that have been around the channel for a bit, you'll know that I love recurring revenue sources. And while Shopify has cheap plans at $9 a month for merchants, they also have Shopify Plus, which costs $2,000 a month. And it's so popular, and it brings in 29% of their monthly recurring revenue, which I absolutely love. They've also recently invested in a firm which recently IPO'd and shot up immediately after, which made them a lot of money. So Shopify is a very interesting company. They have deals with stuff like Pinterest to be listed on their site. And since the compound annual growth rate of 71% over the past 5 years makes me feel a lot more confident in investing in it compared to something like an Etsy. But I do still have the same problems that I see with Etsy, where they are both very overextended. In the past 5 years, Shopify is up 5,100%, which is nuts to think about. But when you see the growth of the stock price of something like an Amazon, this isn't unheard of for this type of company. So as of right now, I do like Shopify more than Etsy, but I will give my final rankings towards the end of the video. And next up, we're going to be going to a veteran of the e-commerce space with eBay, ticker symbol EBAY, which is currently trading for $56 and it's up 12% in 2021. Looking at the 1-year chart, you can see that they saw nice growth in 2020 at 58%, but it definitely lags behind the other newcomers like Shopify and Etsy. And with the 5-year chart, eBay is only up 114% compared to the thousands of percent that we saw with Etsy and Shopify. With their revenue chart, it shows the restructuring that eBay has had in the mid-2010s. The mid-2010s weren't the best time for eBay, as they had to change a lot of the ways that they were doing business. Also, the disconnect from PayPal definitely hurt them. And while they don't have the explosive growth of something like an Etsy or Shopify, it does have the name recognition, and it's been around forever. This is one of the few .com companies that have really stuck around since the early 2000s. When I'm reading about Jim Cramer trading around the .com bubble, it's really interesting to see him mention all these companies that have gone under within like a year after the bubble burst. So eBay is still around, and it is the king of margins. From everything I've seen, eBay's fees are extremely high when it comes to these selling fees. It's around like 10% from what I saw. And that's why I'm making my case for why I like eBay more than something like a Shopify or an Etsy. Just a reminder that Shopify had a net margin of 8%, and they've only been profitable for like 1 quarter, and Etsy is only up at 17%. And so eBay is the king of net margin, currently sitting at 46%. What this means is that they're incredibly efficient at bringing in revenue and keeping it as profit. So they have incredibly high fees, and with that spike in sales in the past year, that's resulted in a huge increase in their net margin. Put that together with the fact that the pullback wouldn't be too extreme for eBay, considering they are only up 114% in the past 5 years. I do think that it's my favorite out of something like an Etsy or a Shopify, but obviously it does not have the excitement or the growth potential behind it, considering eBay has been around forever. And then I'm going to wrap up this video talking about a stock that I've never discussed on this channel, and I'm assuming most people have never heard of it. I'm going to be talking about Jumia, ticker symbol JMIA, which is trading for $44 and it's up 9% in 2021. For people that feel like they might have missed out on the e-commerce boom, this could be a decent option. And so Jumia is an online marketplace for several African countries, but it is based out of Germany. Looking at the 1-year chart, the stock is up more than 400%. But when you see the all-time chart, it's not as pretty. You see a steep decline right after the stock IPO'd, and it has been climbing its way back ever since. And this comes after notorious short seller Citron came out and said that they could potentially be a fraudulent company. If that name reminds you of anything, they have been very vocal recently, talking out and being a short seller on Gamestop, which they recently got burned. And so I think this might be the type of company that anytime that they make a claim in one direction or the other, I think it might be beneficial to be going completely against them. So they shorted NIO, which was not a great idea. NIO has been one of the top performing stocks of 2020. They shorted Gamestop in the past couple months, and they got burned by the short squeeze. And then the one stock that they were really bullish on, which was Luckin Coffee, and that's a company that got removed from the New York Stock Exchange because of fraud. So at this point, I don't really listen to anything they say anymore. But this is a very young business, and they were not really able to grow during the pandemic, as we saw a retraction and a shrinkage in their revenue in 2020. So this is a very interesting company. Their net margin, which has improved, but it's still more than negative 100% for their net margin, and they're not even close to being profitable yet. And this is a company that I would invest in if I wanted to really hit a home run. The reason behind that is the bull case is that they only have a market penetration rate of 3% in Africa, which is extremely low and shows the amount of growth potential that they have. The problem is, in the bear case, is that the African continent only has an internet usage rate of 39%, which is way below the global average. And for an e-commerce site, access to internet is critical for their growth. So at this point, it's a very interesting opportunity. They are not profitable, they're not even close, but they have such incredible growth potential. And so you do have some of the worries about the claims of them being fraudulent, but based off of the companies that have invested in them in the past, I think it's an interesting option. So now that I've talked about these 6 stocks, I kind of wanted to rank them and discuss how I feel about each one of them. My first and my favorite overall is going to be JD.com. I think it is the most interesting company. I think it's the most like Amazon based off of their incredible logistics network, which allows them to be more hands-on with the way that their products are being shipped out. They do have the growth potential of their cloud service and their telehealth coming out in the next couple years. So I do think it has a lot of potential there. Next up, I'm gonna go with Alibaba. I think Alibaba is still good. I think the recent sell-off based off of the Jack Ma news and the problems with the Chinese government is a little bit worrisome, but I don't expect this to be a crippling part and just kind of destroy their business. So I'm not super worried about that. Next up, I'm going to put eBay, just based off of their incredibly high margins and the fact that they've been around forever. Also, they are only up around like 115% over the past 5 years. So if we do see a market sell-off, they're not going to be crushed by it like something like an Etsy or a Shopify that are up thousands of percent. So then after that, I will put Shopify. I think it's very interesting based off of their recurring payments, but I do have a lot of worries about their long-term health of the company. And then finally, I'm going to put Etsy at the bottom just because it's not something I've used. And I think it might be a little bit more of a fad than something like a Shopify. And then finally, I'll put Jumia at the bottom just because it does have a lot of risk. But this is a company that has a lot of risk, but a lot of potential if it does very well, considering that it has not seen the explosive growth that the other e-commerce stocks have seen so far. So I'm very curious what you thought about these companies on this list. And let me know if you'd ever consider buying these stocks over a giant like Amazon. Thanks for watching this video. I appreciate all the support, and I will see you in the next video.